Every time we learn even the smallest eye-opening fact about finance, our brain somehow encourages us to consider investing. And that's good. Nevertheless, before you start your financial voyage, you must consider the kind of investor you want to be. Do you desire to be a capable investor? Alternatively, you might just want a piece of the investment action. If the former describes you, I urge you to watch this video all the way through. We'll be sharing some of the do's and don'ts that a wise investor lives by. In addition to his student Warren Buffett, Benjamin Graham is arguably the most skilled investor of our time. We'll be borrowing many of his ideas and strategies. Let's have a look at some qualities that every wise investor possesses. 1. They never trust the market. I strongly advise treating the stock market like a woman if you want to be a wise investor. Allow her to wow you with her beautiful appearance, but watch out for her bizarre behavior. The majority of them are transient and just serve to exaggerate the situation. If you want your relationship to develop into a serious, lasting one, you must ignore her outburst. The stock market, where stock prices will soar to absurd heights, operates similarly. Sometimes, however, they'll plummet to an obvious low. You might be wondering how. As I already mentioned, the market is prone to mood swings and can erupt at any time. That explains why stock prices for a device that has been the subject of months of raving climb sharply, only for it to crash following the release of the device since it fell short of people's expectations. Intelligent investors seldom sit around trying to predict the direction of the market. Instead, they work with research that has been adequately conducted. So, conduct a self-analysis to identify your issues, then practice discipline to avoid developing harmful investing habits. 2. They put all their investment eggs in one basket. Diversification, according to Warren Buffett, is the defense of ignorance and is useless if you know what you're doing. He most likely intended for you to ignore bank advice to diversify your investments widely when he said this. This is primarily due to the fact that diversity doesn't always result in losses being limited. Your potential for growth is more likely to be stagnated by this investing decision than it is to be protected. Which world do you expect to understand every idea behind 100 enterprises? Logically speaking, it is impossible to devote the necessary time and energy to thoroughly researching all of these businesses so that you can make an informed investment decision. Selecting no more than 5 investments is preferable. You could then continue learning everything there is to know about it. Always keep in mind that excessive diversity is a surefire indicator of mediocrity. And any wise investor doesn't want to be connected with those statements. Therefore, avoid dipping your fingers in any pot. 3. They set an investment formula and stick to it. When it comes to investing, your emotions are your worst opponent. Therefore, you must do every effort to create distance between the two. Even if it requires creating a rigid formula that you have to work around each time you make an investment. For the Graham students, investment follows a formula. The term dollar cost averaging is what the rest of us are more familiar with. It implies that you must establish a specific budget in order to be a successful investment. Establish a fixed amount of money that will be invested either monthly or quarterly. This sum is meant to be used consistently to buy more of the stock you've previously chosen. It costs a lot to buy, regardless of price. Although it will be emotionally taxing for you, this is a necessary evil. You must do it in order to develop into a knowledgeable investor. This is also a fantastic approach to guard against losses that may result from making significant, one-time investments. 4. They apply Graham's 3 principles to investing. One of the best traits an intelligent investor can hold is practicing this principle from the guru himself, Graham. Before you invest in a company, always go deeper into your research. Analyze their company principles and their performance for at most the last decade before you decide to invest in it. Diversify your investments to shield yourself from the losses that come with the monotony of your investment. Choose investments that offer slow and steady returns instead of those that promise insane profits. By assuring thorough investment study into everything, these ideas are simple to understand and put into practice. Pay attention to the difference between a company's current prices and any potential future value. Choose 3 or 4 of these businesses on which to concentrate. Because you didn't keep all of your investment eggs in one location, you'll be able to save a good chunk of them, which will help you prevent losses if things don't work out. Through a 10 or 15% yearly return, you can later continue to reap the rewards of your labor. Which is typically the absolute minimum, but over time, these little profits build up. 5. They aim at capital preservation above all else. Making sure they expose themselves to as little losses as possible is a wise investor's key agenda and purpose. All of this ought to be accomplished without putting at risk or restricting prospective capital gains. Therefore, Wise investors are concerned about protecting their investment cash. They would prefer to balance their losses and gains, keeping their initial investment intact. One may argue that this amounts to the construction of a safety net of sorts for them. The phrase margin of safety is used increasingly frequently. This indicates that these investors will make nearly risk-free investments. Additionally, they avoid making investments that have a high likelihood of becoming dangerous. Every investor's primary goal should be to limit their losses. And this does not imply that you should immediately steer clear of all dangers. Try to stay away from anything that could cost you a sizable amount of money in losses. A wise investor would never compare their results to those of the market or the state of the economy. No, they make an effort to get a genuine positive return every year, regardless of the situation. They don't care if doing so results in lagging market indices. Because the sky's the only limit for them, they won't give it a second consideration. How would you recognize a wise investor in this scenario? They will always invest in assets with a high safety margin in order to protect the investment funds. If capital growth results from this strategy, they will only view it as a success for their techniques. 6. They ignore market fads. There have been several rumors regarding a big-name investment spread over the years. A good example of those that are essential in our community is cryptocurrency. Do you recall how people make predictions about this topic, claiming that paper money would eventually disappear? Additional hypotheses? There is absolutely no substance to this debate, which lacks foundation to begin with. Consider yourself an astute investor who understands that anything can happen in the future. Its course, much like a virus, causing many stock market investments, including cryptocurrency, to fail. Be prepared for whatever is coming because it will happen. There won't be any red warning lights or yelling at you to slow down because there is danger up ahead. Stay focused at all times by continually educating yourself on these crazes. Due to this, you'll be informed of what is occurring and its purpose. Additionally, you'll be better able to predict the outcomes. 7. They let opportunities pass them. Do you ever wonder why the most successful investors don't sell their stock just because the price suddenly tripled? The majority of people would probably be frantically rushing from their broker to their bank to make as much money as they could. Because of this, the majority of people are far from the elite investors. These select few possess the quality of patience, which causes them to let opportunities go by. They realize that in order to generate a solid return, it is not required to seize every chance that comes your way. They are intelligent beings who won't pursue every mouse that darts across the floor. Instead, they'll conserve their strength and patiently wait for a chance they can boldly seize. If prices start to decline suddenly, this advice will help you avoid losing money. You cannot complete this assignment if you are emotionally fragile, I assure you. Before you can effectively manage your emotions, you need to practice and realize that it will take time. No matter what happens, even if it means seeming like a fool because you refrain from purchasing a particular sort of security, only for them to experience a turnaround in their financial situation. 8. They take advantage of the falling price. You need to be able to think quickly and remain calm before making decisions if you want to be a successful investor. This distinguishes wise investors from all other types of investors. Because they maintain their composure despite falling market indexes. The rest of us react in a panic at even the smallest discomfort, leading to hasty decisions that will ultimately cost us. Money can still be made, which is fortunate, even if your point of view differs from everyone else's. Realizing your investment's value, even in difficult situations, is the only way to maintain your investment program. If your decision to make that investment was justified. If so, it makes little difference if the price is decreasing because you are confident that things will come out well. Even better, you are confident that your decision is supported by extensive study. In these uncertain times, have courage because no one can ever time the market perfectly. And that's one of investing's appeals. 9. They follow either of these two portfolio policies. Even after deciding which investments to make, a savvy investor continues to do their homework. The largest effort will then be choosing and keeping an eye on a certain investment mix. Another chooses a long-term investment portfolio that can operate automatically. Make sure that the portfolio you choose fits your needs. By taking into account your way of life, your romantic situation, and any family demands you may have. Sadly, the video has come to an end. But before I conclude, I want to give you a strong recommendation for Benjamin Graham's book The Intelligent Investor. In his writings, he has taken the effort to thoroughly define these characteristics, while also highlighting the specific ways in which your financial decisions have been flawed. If you have read the book, please share your thoughts in the comment section. So, thank you all so much for watching, and please don't forget to leave a like and subscribe to the channel before you leave. So with that, have a wonderful day and I'll see you all in the next one.